Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to rip through Twitter, see what people are talking about in social media. I'm going to interject my financial opinions. It's going to be commodity, finance, and or wealth building topics. Sometimes I agree with what's being posted. Sometimes I disagree with what's being posted. If you follow me on Twitter, make sure that you listen to these things so you just don't take in all that information when I'm sharing. I'm sharing information, and some of it I disagree with on the website, just to let you know on Twitter. So if you want to follow me on Twitter, it's at finding_finance. And if you want to join the website and our community, that's finding-value.com. You can use the word discount, the coupon code if you'd like to join. And you can follow me making purchases. We talk about individual companies. And again, I can't do anything one-on-one or anything like that. But you can follow what I'm doing and how I'm playing the bull market. So we've got Energy Cynic here. He says, rig counts coming down even with oil at 80. Middle East instability, Russia sanctions eventually going to bite. Demand is fine. World will always revert to growth. EV adoption slowing. OPEC plus backstopping the market. SPR needs a refill. Did I miss anything? And I would say that he is missing something. One thing that drives these markets is the credit expansion and contraction in the system. So if credit contracts, or if there isn't much lending going on in the system, it can bring oil down. Even though you've got all of these positive factors going on in the market from a supply-demand perspective, credit is demand for oil. And I don't see anyone talking about credit expansion and oil price. Although every single time oil has gone in these big boom phases, it's always been under a credit expansion phase. So you could say that demand is increasing during these credit expansion phases, and generally it goes along with more home buying and a bigger demographic. So they are all interconnected. The one thing that is difficult with this cycle that we're in today, I agree, demand is fine from an actual demand for fossil fuels. But the credit side, sometimes people, the investors, get worried if the credit isn't expanding. And we know that home sales have definitely dropped in terms of volumes. The volume of home sales has dropped, which means the total aggregate sales has dropped, which generally indicates that the total loan creation process has also declined. And that does take liquidity and inflation out of the market, which is generally good for oil. Not that it's taken out, but credit expansion is good for oil. Liquidity and credit slowdown is not good for oil. I was just looking at this chart. I didn't even notice that it was uranium versus SPX. It says choose your fighter. And I was like, man, this looks really good. and I looked at it. I'm like, oh, well, yeah, it's uranium. Yeah, uranium looks fantastic against the S&P 500 on a monthly candlestick basis. This is your base. This is your bottom. This is your ideal buy point was right here. That was your consolidation on top of the pattern there. And I actually think let me yank up that ideal buy point just to show you guys that I'm not full of it. So the ideal buy point on that, if I can find it here, and come on, it shows up in my main thing, but it's hard to find there. I'm technical. I'm not going to be able to pull it up. No. Oh well. Well, that's the ideal buy point. If you look at technical analysis, you get a basing pattern, basically a double bottom. This is like a triple bottom. And it came on up, broke out of the basing pattern, and then it consolidates right on top of it. A lot of the times people consider this a head and shoulders pattern here. We've got that pattern across a bunch of different commodities right now, and this generally fakes people out. A lot of people think, oh, it's a head and shoulders. You don't get these head and shoulders topping patterns off of a base most of the time. I mean, you can pull back, and it is possible to get a smaller head and shoulders pattern, but most of the times this is a lead-in pattern. where it comes in, it consolidates, and then it's a lead-in for a much bigger, larger move. Another thing to notice here is we have come up pretty quickly, and if you go to the left, you can see that we are coming into some resistance here. A lot of the times, the way that this moves up is the way that the stock or ratio has fallen. So I think we're just up in resistance at the moment. And I don't know how long it's going to take to get through that, but we're up against some resistance. Rick Rule says, taking a 30% loss on a speculation has absolutely no impact on me psychologically. It's the process I pay for success. You guys, if you're speculating, you could be down at 30% in like a day. I mean, small speculative companies, and depending on what you're speculating on, maybe if you're speculating on the commodity price, I mean, it's going to happen. You're going to get losses, or you're going to be down in your account at some point. It is inevitable. The way that you respond to that is where you make all the money. It's how do you respond to the market movements and the volatility. What strategies do you have in place? Are you cost averaging in? Are you buying it in tranches so you're not trying to put one position all in at once and try to time the market? I mean, obviously, we're trying to time the market as best we can with technical analysis, but that's not going to be perfect. And if you have all the tailwinds behind you and you slowly accumulate at very good buy points, which means that you're buying on things that are reversing and turning upward, that's about as good as you can do. About as good as you can do. And sometimes you're going to have some losses that you're going to take. And if you're in an individual account where you can do tax loss harvesting, where if something's down, you can sell it and take the losses in an individual account and write them off from a tax perspective. And then you can move that money potentially in a different account, like a 401k or something like that, and then buy the same stock. I mean, there are things that you can do to move that into different accounts and whatnot. Oil possible outlook. So what he's got here is a kind of an upward channel. We've broken that, been moving downward. And maybe we do a double bottom at 77, 78. That's kind of what I was thinking. I was like, maybe this can get down to 77, 78. But I mean, there is the possibility it could go all the way down to $68. I mean, it is possible. It all depends on the market. I know there's a lot of really bearish action in the market right now, which is generally bullish. So we'll see what the next few days, what kind of candlesticks we see. I'm looking for a hammer candlestick, a bullish engulfing, bullish piercing, some sort of pattern that hopefully shows up over the next week or so, or maybe it takes a little bit longer. Oil seasonality in line with historic trend. This is WTI crude oil futures seasonality. And I don't hear too many people talk about seasonality here, but this is the seasonality if you were to look at it. It looks pretty stable in January, February. It really goes up in February. We get another nice move in the springtime into early summer. Then we start tracking lower towards the back half of the season, and you can definitely see a big sell-off in November. November is the highest selling pressure month into early December. I didn't even know that. I knew that the fall was typically a slower thing, but I didn't realize it went down that much in 1 month, which is kind of interesting. Come on down. Did you know millennials are exactly on track with their wealth accumulation relative to previous generations? No, they are not significantly poorer than previous generations. That is a myth. This is generational wealth per capita. Inflation adjusted with CPI, and the millennials are right on track with Generation X and the baby boomers, basically all on track together. So I hear a lot of people talk about the millennials. Oh, the millennials, they're not as rich as the baby boomers. It's like, yeah, the baby boomers are old, and the millennials are still young, and that's why they have got a lot more money. They've just been investing and saving a lot longer. That is generally how it works. You can see Generation X is blowing past the baby boomers given their age. I'm the oldest millennial. I would be wealth per capita, I guess it'd be off this page, I guess. But yeah, I mean that's what it is there. But I'm the oldest millennial. I'm 42 here. So I'm 42, and that would say that I should be at like 200 and something thousand for wealth per capita. Warren Pye says, oil, let the correction play out further. Calm down, guys. Seasonally, November's an awful time, coming off the back of Mexico's Hacienda hedge. Under the surface, positive things are starting to build, says Warren. Dated Brent hit $97 a barrel last week. Hedge funds' CTA short positioning has fallen to multi-year lows. That is generally a good time to buy, not to sell. So when you get these bottoms here, that's generally a good time to go long and look for potential buy points where we start to turn around. So yeah, Warren's definitely right. A lot of people are very bearish right now. And seasonally, November is rough. We just looked at seasonally up here that November is rough. Trying to show you guys all the data, get you guys a little bit more confident that don't be scared. You just got to wait this through, find a bottom, and we'll try our best to add to the portfolio with companies that are bottoming out and look really good. The U.S. government has a big spending problem. Total U.S. debt has surpassed $33 trillion, levels that have never been seen before, and continue to climb rapidly. As a result, debt to GDP has reached 120%. I think there was something written by Rogoff or something where he said, whenever a country, whenever their debt to GDP goes over 130%, it's basically screwed. Like they've never been able to unwind it. So we're at levels that are just underneath 130%, and maybe they can't wind this back. Which means that they always end in these gigantic inflationary problems. They can maybe stretch it out depending on the demographic. Japan stretched theirs out, but a lot of the times it ends in an inflationary problem. And we're right there knocking on that doorstep of the 130%, where we could go into uncontrollable debt to GDP movements. And all of the projections that I've seen has debt like expanding and exploding higher against GDP. This guy, can't remember his name. He's really popular. Whatever his name is. He says, I suspect at some point someone's going to dump their tech stocks. They're going to start rotating into commodities, and when that happens, you'll start to see other people follow suit. And why we're still early on the Grant Williams, that's what it is, Grant Williams. So that's Grant Williams' opinion, same as mine. I think tech's going to get into some headwinds at some point. Commodities is where the action will eventually be. But I know in the short term, people always get pretty. Their emotions are bullish when the price goes up, and they are bearish when the price goes down. I think what you need to have as a mindset is to maintain bullishness. Almost like people would call me a perma bull. But I'm a bull when I need to be a bull, which means this entire secular bull market, which started in 2020, I'm going to be a bull until that gigantic secular trend is done. And that could happen. I could be a bull for 10 plus years. And I'm going to be a bull when I need to be a bull. Joseph says MMT, that's a money market theory, or no, what is that? Whatever the acronym is, monetary whatever theory, makes two fundamental mistakes. It conflates money and wealth. These are not the same thing, but pretending they are makes MMT seem to make sense. It assumes society or the economy are real entities. They are not. Only individuals exist. The aggregate of the individuals does not exist as its own entity. With these two misunderstandings corrected, all of MMT falls apart. So that's modern money theory, I think is what it is. I was trying to remember that. CEO technician, this looks like a well-constructed pattern in OIH. And here comes out the people looking for the shoulder, head, shoulder topping patterns. Again, remember some other people who came out with shoulder head shoulder topping patterns in uranium. And you know which way that resolved? Upward. In my opinion, a lot of these are the lead-in patterns. The lead-in pattern is what comes off of a base. And a lot of people think it's a shoulder head shoulder. So if I were to kind of blow this thing up, I don't know why it's doing this. Edit. File, new, don't save. Okay, so there it is. What the lead-in pattern is, if I can draw it, there it is. My awesome drawing. The lead-in pattern looks like this. It goes up, comes back, comes down, and looks like that. And they're going to say it's a shoulder, a head, and a shoulder, when this is actually a lead-in pattern to go higher. And generally, it tips a little bit below that. So it comes, dips below, and then it comes and it rips to the upside. I've seen this pattern over and over and over at the beginning of very big bull markets. They generally occur when you've got a basing pattern. So it looks like this. You usually come in, you get a basing pattern that looks like this. It breaks out, and then you get a consolidation. The consolidation can look something like this. The consolidation can also look very similar to, it can also look like that, which looks very much like a shoulder head shoulder, which is generally located right in the ideal buy point for technical analysis. So that's where I think a lot of these are at. Now, it could break down. It could go a little bit lower before going higher. There's no doubt about that. So that's what I'll say. Now, if this is, what that would mean is that we get a slowdown in the market. And if we get a big slowdown in the market, which is credit contraction or a big credit slowdown, it is possible that it does go down and will play out as a shoulder head shoulder. It is possible. I'm not going to say it's impossible, but a lot of the times people confuse these. They're in very good locations, and this is not a shoulder head shoulder in a large big picture view. And also notice that the left shoulder isn't on the neckline, so you can't draw it sideways. Total U.S. credit card debt hit a record $1.08 trillion in the third quarter, rising 16.6% over the last year. And usually you get credit expansions during portions, and then when credit starts to contract, that's when you get problems. Now, I'm not saying credit card balances are necessarily the end-all, tell-all, but it could be. You notice that we saw a fall in 08, we saw a fall in 17, 18, and then 19, 20. That's a big move lower there. And now we've come on up, and it looks like it is starting to kind of turn on over. Structural underbuilding, not the Fed, broke the housing market. Fed President Kashkari says. Now, I know some people in the comments section, we do not have underbuilding, structural underbuilding. Well, the Fed thinks we have a structural underbuilding. So are you arguing with me and the Federal Reserve now? Now, here's Kashkari straight out of his mouth. Let's talk about it. In the space of 3 years, we've had both record low interest rates and the highest rates in several decades. Is this housing market broken? Kashkari says, well, I think since the pandemic, we have structurally underbuilt the number of units we need to meet our growing population. And that's the factor. And that's really about regulation at the local level that are creating barriers to more supply coming in. The interest rate environment will settle out over time. But structurally, we have to actually bring a lot more supply online to meet Americans' needs. Guys, he's telling you exactly the thesis where we need to structurally have and to bring on a lot more supply. That will be inflationary. And interest rates are going to have to balance this all out. He says, you say over time, bring more supply online, but it could be like 20 or 30 years. I think this is the issue here. The legacy of the FOMC could well be a generation of people locked out of the housing market. Kashkari says, why do you say that? There could be a generation of people with 2 and 3% mortgages that never sell their home. And that's what people were talking about as well. They're like, well, the inventory isn't going up because people aren't selling their home. And Kashkari says exactly what I say. Yeah, I don't know about that. People end up needing to move. It's funny. When people don't sell their home because they're locked into a low mortgage, that's less resale supply. but that's also one less buyer. Most people who buy homes are leaving another home. So that both affects both the supply side and the demand side of the housing market. And I hear these people, they're like, well, people aren't going to sell their house. It's a buyer and a seller. What people aren't doing is they're not moving from their first house to a second house. They're not moving up into a larger home or moving into a different location, perhaps. But that doesn't impact the supply stock. You still have a younger person buying a smaller home, perhaps, and then that person who is living in the home still needs to buy another house. And that house may not exist. And that is where we have a structural undersupply of the market, like Kashkari says. He's exactly right. And guess what? If we're structurally underbuilt and we need to bring a lot more supply online to meet Americans' needs, it's going to be inflationary. And that's coming straight from the Fed's mouth, right there. The attack Monday mornings, this is Gary Savage. The attack Monday morning arrived right on schedule. The bottom may occur today if gold can hold on to the reversal. Then we will get another run at the $2,000 level. In his opinion, they're trying to bring this sucker down. In my opinion, I find it highly weird because we've got interest rates coming back down. The yield curve is sideways. I would expect this to try to run here. If the reversal can hold on into the close, this may be the bottom of the attack and another run at 2,000 begins for gold. Josh Young, price drives narrative we continue to face into the storm. There's been quite a sell-off in oil the past few months. Ironically, many of the same market participants who were excited about the oil and gas prices and equities this spring and summer have since turned lid bearish. Price drives narrative. And a lot of investors want to invest when oil is at 120, but nothing at 70. That's what it is. This is EXK, Endeavor Silver. Silver miners hit with massive cost inflation. Endeavor Silver, the all-in sustaining costs, hits a mind-blowing $29.64 per ounce. Don't think this will stick, but goes to show the issues silver miners face with energy cost push inflation. I recently did an interview with Capital Cosm, and I talked about the cost push inflation that a lot of these miners are experiencing. Their margins are contracting or going negative in some of these silver mining companies. For instance, Endeavor Silver is at $29.64. A lot of the new mines that are going to be coming on are not going to be cash flow positive with their all-in sustaining costs where the price of silver is at. Now, some people will say, well, oh, shucks, I should, the miners might not be a good play. But I can tell you this, the physical metal at the price that it's at, and if these guys all-in sustaining costs are in the mid to high 20s, the price of silver is going to have to go higher at some point. It's too low. And I think it's going to go up massively because we're underneath a lot of resistance. And once that resistance breaks, it's going to run large. So some of these companies that are more of the higher cost producers, they could be good investments. But in my opinion, physical silver, with where it's priced today, is more of a sure bet than any of these mining companies are. Because if they continue to experience cost push inflation, where their all-in sustaining costs continue to rise, that means their margins aren't going to expand unless silver really starts to hit it to the upside. But at that point, if you're in the physical metals, you're already making money because there's no margins to worry about. It's just the price of the metal. Royalty companies are going to do really well as they're going to do very well under these conditions. Warning, banks' willingness to lend has plummeted, making credit availability increasingly tighter. Current levels have typically ended in recessions. This time is not different. So this is the bank's willingness to lend to consumers approaching recessionary levels. This is the slowdown that I'm talking about that is hitting now. This is the slowdown which lending into the markets is expansionary or inflationary. As this contracts, it's going to be a slowdown, and maybe we go into recession, maybe we don't. I don't know, but we're real close to one. When this turns, and we can watch the home builders and KRE, which is the regional banks. If we see those turn up, that's probably more than likely meaning that the banks are starting to lend. And if they're starting to lend, inflation will kick up, but it will kick up with a lag. The lag is generally 12 to 18 months. So we've been at a high level here, and it came on down. So we could see a lag here. This is Q4 2022. There could be a lag here, and we could be feeling that slowdown here very soon. Still playing out the gold quarterly. We haven't broken out yet, but I have a feeling we're going to break out. There's your bottoming pattern. This is an inverted shoulder, head, shoulder, the breakout and the big run. The projected move is this guy here put on top of it, and it's probably pretty close, maybe a little bit it overran the projected move a little bit. And now we're moving on up in a bullish pattern, which I think will break to the upside. Kelly says, I have my annual review today. I was emailed this morning a bunch of talking points. Salary, of course, is not on the list. How would you bring that up to your employer? Well, I was pretty cool with everyone who reported to me, and they spoke very freely to me about salary and all of those things. And I would tell them a lot of different things of where they're positioned, why do they pay a certain thing, and a lot of the times the person, the manager themselves, does not have 100% control over your pay. What generally determines your pay, and I don't know what this guy's situation is, but generally what determines your pay is the level that you're at, where you're at in that level, and then basically they benchmark or do a comparison against other people with roughly the same amount of experience, roughly the same amount of years, to see where you're getting paid in relationship to those people. And that is how you can get a raise, is you're under the normal person, and they would maybe market adjust you, give you a market adjustment, which is a adjustment that is out of cycle from a merit increase. A merit increase is just based off of what you think someone has given you. Generally, merit increases, what they do is they have a pool of money that they give your group. The manager then doles out that money. So let's say the group gets a 3% average increase, and you have a certain budget on top of it for promotions. They're two separate buckets. And then you have to divvy up the merit increases. So if someone gets greater than a 3% raise, you are taking it from someone else. Generally, what occurs is the younger individuals get more merit increases than the older individuals who are higher paid and on the higher end of their pay scale. And that's generally how it works. If you're on the higher end of your pay scale for your level, they're not going to give you a pay increase. They're not going to do all that stuff, unfortunately. Most of the time, they don't. I do have a Capital Cosm, one of the videos. There's a part 1 and a part 2. This chart is showing a huge breakout for silver versus the S&P 500 and a second big backtest completed. A line chart shows early what is happening. A historical massive asset class paradigm shift in the making. And this is silver versus the S&P 500. We've basically had this nice falling wedge, 15-year bullish falling wedge that's broken out to the upside. The market conditions for gold and silver to go up is generally when there's a market slowdown. What it is pricing in basically is the metals, the physical metals do very well under this condition because late stage, generally people run to two asset classes, long duration bonds. So we should see the 10-year, 30-year fall, which we're seeing. Then you start to see gold and silver also outperform. This is pricing in future stimulative measures, in my opinion. because at some point the market is going to have a credit expansion again, and credit has been slowing down. So during this time of the cycle, if we're in that cycle, because we could be in like a mid-cycle wobble and we stay inverted because the housing market is not driving this. But depending on what has to get flushed out of the system, gold and silver generally perform very well during this time. You can see that the TSI or RSI moving on up, it's a divergence from the price. So this definitely looks really good. It says, with metals outperforming the general stock market, global capital is flowing into the precious metals sector. Here it comes, guys. It's coming. This chart looks explosive. Despite all the focus on the Magnificent Seven and overall U.S. equities, Brazilian stocks are on the brink of a historical breakout. Why would anyone invest in U.S. stocks at 50 to 100 times earnings when you can acquire shares of well-established Brazilian companies at just 5 times earnings with strong ties to commodity prices? Some might argue that it's a value trap, but similar skepticism existed in the early 2000s before Brazilian stocks surged 16-fold. I think that Brazilian stocks look absolutely excellent here. They look fantastic. It's going to break, and generally when this occurs is when the U.S. dollar falls and when interest rates fall, and this currency is going to strengthen, and that's generally when it rips. So emerging markets, in particular Brazil's markets, look absolutely fantastic. And that's where I am going to end it, is right there. So that's what I've got for today, guys. Give me a thumb up, subscribe to the channel, subscribe to the website, and everything still looks good, guys. And we could see some volatility in the short term. We could see a slowdown. Totally agree with all that. And it may take some time for this to all work itself out. In the meantime, do something fun. Do something fun. Don't get too crazy over it. We had some really good weather here today. I enjoyed it thoroughly. I was outside a lot because I think this is the last day that we're going to hit over 70 degrees for a long time. But hopefully everyone's having fun, doing well, and that's where I'm going to end it. All right, guys, we'll catch you next time. This is Finding Value.